do you want me to tell you what's wrong with your product? And I've already given you like 5 of your biggest customers as word of mouth. I no longer recommend you. Do you want to know why? And she ended the Zoom.
Seriously?
What?
Really?
And I don't blame her. Yeah, she just didn't want. It's just that, and then all of a sudden, it didn't want to know that. It was just, let's just get through my slides.
Wow,
Shit.
We have 100% utilization, 100% that. No, it's not 100%. It's like
what was the name of that? I'm just kidding.
I've had so many. I can't do them.
This is Top Line.
Today's episode is brought to you by 6 Sense. 6 Sense Revenue AI eliminates guesswork and arms your revenue team with the data and visibility it needs to create and convert high-quality pipeline into revenue. Traditional revenue technologies can't detect anonymous B2B buying activity. This creates a dark funnel that leads to mistimed engagement or missing out on opportunities altogether. 6 Sense Revenue AI eliminates hidden buyer behavior in the dark funnel while enhancing the technologies you already use. You'll capture every revenue moment and deliver more predictable revenue. Find out more at 6sense.com. Hello, everybody. Welcome to episode 33 of Top Line. It's me, Sam Jacobs, CEO Pavilion, Asad Zaman, CEO of Sales Talent Agency, AJ Bruno, CEO of QuotaPath, and with us today, a very, very special guest, Jason Lemkin, the SaaStr's himself, the godfather of SaaS, founder of EchoSign back in the day, founder of SaaStr's Community, SaaStr's Conference, famous investor to a bunch of amazing companies that I don't know all of them. TalkDesk is one of them. Maybe Owner.com is another recent one. Salesloft, amazing.
Yeah, a lot of good ones.
One of the most well-known
enough
people.
to speak with authority. To speak with authority. Let's say above enough to speak on some of these issues. Not any necessarily better than that, but.
And you've been at it for about 10 years now, right, Jason?
I've been at what?
Investing?
Yeah, I've been investing just long enough to understand how it works.
Okay.
What have you learned?
I think, and look, some of the lessons are tough, right? For others, I've learned that, lowering the bar even a tiny bit is a complete waste of time. It's, when I started like this idea of power laws, I found kind of soul crushing, and very producty. Like the last thing you want to hear as a founder is that where do you sit on the power law scale, right? It really is a soul crushing thing. And I remember when Emergence Capital backed me in my batch were David Sachs from Yammer, I still know him, and Renee from Bill, and Peter Gassner from Viva. And I learned a lot about it, but it was still so long ago we didn't understand this. But the problem is in investing, if you really don't invest in something huge, the dilution for energy, time, money is so high over 10 years, right? And that's what I learned over it. And in the beginning, I was lucky. I was 5 for 5 when I started. So the first one was Pipedrive. That sold for $1.5 billion. Then Algolia, we're at 200 something million. They'll IPO when we get ready. Then it was TalkDesk, right, which is worth at least billions. Then was Greenhouse, which will IPO. It's doing a couple $100 million. And the fifth one was Salesloft, which we sold for $2.5 billion, which was the last deal of the bubble. Salesloft was the last deal to close. At the end, it was very interesting looking back. It was the last deal to close at 2021, and things were already crumbling when it closed, right? The deal would not have happened if it was 1 week later.
And the other weird thing was
1 week later.
There was some commentary at the time that Kyle sold early and that Outreach was going to be the consolidator and the dominant platform in the space, and that Kyle kind of pulled back. And now in retrospect, it looks like he perfectly timed the market.
He knew, he was right. It was interesting. I was very involved with the company in the beginning and put together all the funding and pre-revenue, but I was not on the board. But from the sidelines, it was interesting. And, a lot of investors were not excited about the sale. They thought $2.5 billion or whatever was fine, but why would you sell when things are trading at 20, 30, 40, 50x revenue, right?
I can tell you that wasn't Insight's take on it. Insight was very happy.
They were, but others weren't. So it was interesting. But Kyle was, I think, Yeah, all different interesting. We're all geniuses through summer of 2021, right? Everyone was a genius,
That was my
but
peak
Kyle was
genius
very
was
level.
November.
Kyle was very level about these. Like he did, okay, well, and the irony is, as crazy as the number sounds, selling for $2 billion is not that simple. Let's say you go IPO. Well, you're probably going to have another 30% dilution on top of that when you count the IPO dilution, more. So it's not really $2.5 billion, right? Apples to apples. Maybe it's a $4 billion IPO. Plus, it's another
Wow.
couple of years plus the risk. So what does it have to be? A $6 billion IPO? Like it's not even. It's crazy this math, right? But we all thought we were geniuses, and
Yeah, but I suppose as an early stage investor at that point, what you're liquidating most of your holdings, or is there some of it that you are letting it roll and ride into?
I think different people or whatever. I mean, I wasn't given the option to not liquidate, so all cash.
Oh, okay, yeah. It's interesting. You were talking about, just like we were talking with Mark Roberge a few months back, about the vintages of funds and what those funds look like, the 2012 to 2021.
I don't believe in any of that.
That the funds are going to look terrible more recently.
I think I've had a winner and a loser every year.
Yeah.
And I think vintages, there's a little bit of truth to it, right? In that, everyone had some dumb deals and paid up in 2021 or late 2020, but these are this is too much inside baseball. The way founders work is you wake up one day and you see white space. You see something the world didn't see. You see that I'm going to build Pavilion. Like this is going to be real. This is going to be a real community for these executives or whatever you're going to build, or QuotaPath. And you see it, and you don't look at NASDAQ, and you don't look at the multiples, and you don't look at how many companies got funded at the last batch of YC. Like there's moments in time where you see white space and you go do them, and founders are born 365 days a year, right? And so there are no bad vintages, but there are bad practices in investing in bubbly time and frothy times. But there's no bad vintages. I think that's an excuse for poor behavior, I think.
I mean, constantly we're still looking for white space. I could guarantee that all four of
Everyone.
us wake up in the middle of the night thinking, oh,
Constantly.
shit, I got to write that down. And then you write it down and you're like, what the hell did this say? I have no idea what this said.
Yeah. So I don't think there's bad vintages, but I do think everyone is dealing with the downside of the valuations and overfunding of 2021. Like that will reverberate for another 5 years, right? All this stuff, all this acceleration, deceleration funding. And so, yeah, absolutely. There will be VC funds for 2 years with abysmal results, but they didn't have to be.
Yeah.
They didn't have, no one was forcing anybody to do 100x ARR deals. No one was forced to do it.
Well, and Asa just shared Tiger Global's chief solutions officer, which I didn't even know funds had those roles, is stepping down after 20 years with the fund.
He's really one of the co-founders, and Scott Schleifer. But he's I wouldn't feel too bad for him. He's a billionaire multiple times over, but yeah.
I thought Tiger's playbook was a good one. It's just you didn't know how long. It was a pure momentum play, and you just don't know how long it's going to last.
Yeah,
I thought it was a good idea.
And they weren't anywhere near the only ones.
Let's win all the winners. It's the same playbook that Andreessen did.
Yeah.
It's worked out well for them. You just got to play it really, really well. And
if they implemented it a few years later, let's say this downturn had happened and you have like an 8-year stretch of stability, you could argue that would have been a great fund.
Maybe they will. I don't know how many funds they have. It wouldn't surprise me if they had 2 great funds and 3 awful funds.
Yeah,
it wouldn't surprise me at all. Right?
Jason,
they're in a lot of winners.
What happens? So you touched on 2020, 2021, where valuations got quite crazy, and when the market turned, interest rates came up. We're still kind of working through a lot of the challenges of the valuations and its implications for fundraising and all of that right now. And so one thought that the ecosystem learned some lessons around that crazy valuations don't work. And then while we're still working through that, you get this AI bubble that gets built up, right? We were talking to PitchBook, and the analyst shared that AI companies at the infrastructure layer are pulling in $100 million, 100x valuations at the Series A stage, application layer 40 to 50 times revenue. So it seems like the valuations are matching what was happening in the bubble before. And so why was a lesson not learned? Or is it just that the job is to find an outlier, and that outlier in different markets has different sorts of leverage. And if they're in a market where they can command that valuation, we need to get into that company, because it's not about spreading across 10 companies. It's about finding that pipe drive type of company that's going to make it. And if we need to pay extra for that, we have to pay it.
Yeah, I mean, I think the lesson that everyone learned, what most folks learned, is to hunt those outliers, and actually chasing what's hot kind of works. It eventually bites you, but it does enable you to deploy and raise a lot of capital. And every single SaaS investor I talk to, David Sachs, I did it on stage at SaaStr's. You can watch it. 80% of his $3 billion into AI. Byron Dieter, Bessemer, we're basically only doing AI deals. Like one of the OG investors. It is where it is. And you're looking, if OpenAI, despite really is doing $1 billion run rate within 1 year of monetizing its platform, I mean, you got to. It's worth it to try.
Yeah,
to find that, right? It's worth it to try. It's just the returns are so high, so it seems crazy. But the problem is we all get diluted by these revenue multiples when they're really bets. They're really options and bets, and no one's getting. We can talk about what got screwed up in 2021, which is that we lowered the bar in terms of quality of company, because the average SaaS company is trading at 20, 30, 40 times when they're public. Maybe we can have 11 SalesLoft and Outreach competitors or 42 Gong competitors. There are a lot of reasons, but it's still everyone, it's still a business of outliers, and a lot of stuff with crash and burn is part of it. It's just the way it is.
Yeah. And we've talked a lot about that, is that 90% of startups are going to fail. We had 0 failures and bridges all over the place in years. And so the last week we were just talking about the next 6 to 12 months to come. It seems like you're pretty bearish, or at least looking into the future, like until end of 2024, when we'll start to see the markets open up a little bit more.
I'm bullish on. I think I'm bullish on SaaS revenue and cloud revenue. I know Sam and I have chatted about it a little bit, and I know there's a lot of folks at Pavilion and otherwise who have been heavily impacted by the downturn. But actually, the downturn in spend is very specific.
Yeah.
Like if you look at AppFolio, which I just wrote up today, if you look at Cloudflare, if you look at Mongo, it's almost the best. It's not the best of times, but it's darn close, right? And then you look at ZoomInfo.
Yeah.
A year ago, growing 60%, almost 60% at $1 billion, now growing 9%. Like that's where a lot of Pavilion folks are. And there's a lot of impact, but it's not the whole world. So I'm very bullish on where I see spend overall. I'm just, mostly my concern is not that in a year or two we won't start buying more sales tools. I'm discouraged for the first time in my career at public multiples, and I am worried that if we stay in a 6x world, that we haven't really learned to live in a world where companies are worth 6x. I think we've learned efficiency. We get it. We have to people get they have to work harder. People sort of get that sales reps gotta close 3 to 5 times their OT. They don't totally get it, but they sort of get it. They get fundings harder. But we haven't lived in a 6x world for real since 2017, 2018. That's a long time ago, right? So we're not going right now. We actually haven't gone back to 18, 19. We've gone back further. And I'm excited about how the fastest can grow, but this multiple thing, if we stay here forever, it puts a lot of stress on the system. Maybe it's deserved. Like there's no, I don't think the Lord decided what a revenue multiple would be, right? I mean, it's nothing set in stone, but that's the one I worry about. I'm bullish on the rest. I'm bullish on everything else.
It's interesting to see the downstream effects on it. And it is a little bit of a bubble. Like the 3 of us are in sales tech. We're CEOs of sales tech. 4 of us are CEOs of sales tech companies, right? And
I'm not a CEO of a sales tech company.
Yeah.
I guess I sell things to salespeople. That's true.
Yeah. But we see it, but we see the downstream effects that it has on our people more than anything. And just the challenges in terms of like the growth opportunities, and then just when you survey them, just their own motivations and how they're feeling about the world. So like those numbers, those public multiples, eventually it's like you saw the front of the train, we see it stopping. You're like, it's going to hit the caboose at some point in the early stage, Series B. And like we, feel that on our daily operations day to day for sure.
Jason, you made some really interesting bets on the 20BC podcast, and I would agree with your take there, right? That by the second half of 2024, if inflation is already under control, then rates have to come down at some point next year. Even the Fed is saying they want to reduce rates at some point next year. And so as rates come down, valuations just go up. It's just this relationship that those things have.
Maybe.
So you think there's a risk to the
we're all macro geniuses. I don't know.
This is what I was trying to
get to. Congrats to all of us.
Hey, listen, I got
where these interest rates invert to
Penn State.
Revenue geniuses.
So you think that it might be that we might be stuck at this 6x, 7x. That's the risk then?
I think that I don't know. I don't know. No, I just don't. Listen, in life, as an investor, as a founder, as an entrepreneur, I can certainly go. One thing I've learned is to go long, right?
Mm-hmm.
Whatever, something happens, 2 years, it's going to be it's going to be better. Okay. Like I don't even break a sweat anymore. Even in crisis mode, even for SaaStr's, we lost $10 million in March 2020. I mean, the team was pretty stressed. I really wasn't stressed. I'm like, okay, this is not the first black swan event I've had. What do we do? Who do like? There was a sense of urgency, but I wasn't even like it. Didn't even. I don't even know that it bothered me. So I'm not. But I don't know that we know why multiples will be higher. I don't know that everything is just interest rates. I don't know that it's that simple. There are arguments, and for example, I'll give you a disconnect. For example, Shopify's on fire this year. It's up like 98%. Okay, it's reaccelerating at I think 7 billion in revenue. I may be wrong on that run rate, but something like that. It's reaccelerating. And then Klaviyo is the first SaaS IPO in 2 years. Now Klaviyo, it's B2B SaaS marketing, but it's a derivative of Shopify. 70% of its revenue is from Shopify. They should trade in tandem, but it's not. Klaviyo got no boost from Shopify's outperformance. So what I mean by that is I don't think we can predict. I don't think we can have any magical certainty about any of this. We can just see these approximate correlations. But even 0% interest rates, we had 0%. We didn't only have 0% interest rates in 2021. We had them earlier in our careers too. And we didn't have 20, 25, 30x public multiples. So I just think we're geniuses.
That's really interesting.
I think my worry is that it creates stress on any investing from from Series A and later. And my other worry is that on the executive side, I don't know that most folks I work with have the skills to work in this environment. I don't think they're willing to work that hard.
What are the skills you think people need?
I think people have to work much harder than they have for the last couple of years for less money. And here's the most important part: feel personally satisfied about it. What was your Sam in your first AE job? What was your OTE?
I don't know, 200K, maybe.
Your very first job ever?
Mine was $72,000.
My very first job I was making. I was an investment banking analyst at first.
Okay,
so,
what was your first SaaS? So you were before you were at Livestream, you were a rep, weren't you? Or did you go just skip everything and go? I
skipped
sales?
Everything. Well, I was like a head of CS.
You're a bad one.
My first, it was like 65 base. I never had like 50-50, and it was like if I got a 30K bonus at the end of the year if the company crushed it. But this is GLG. They're doing 20% EBITDA margins on 600 million in ARR, so they're fine. But your point is still accurate, which is like the goalposts have shifted, and there's an entire workforce that is. I mean, we had this discussion a couple weeks ago on this show, which is that one of the topics on the docket is return to work, return to office, and I was postulating that I bet that there's a group of people out there that have physical anxiety about going back to the office, largely because their work practices will be transparent to a broader group of people. To your point about working, and that people have been accustomed to putting in 2, 3, 4 hours of work. When we used to get into the office at 8:30, work till 6, 7, 8, 9, 10, and I don't.
We used your Jason your tweet around the like bringing your home life to work, and like the revert. Like we were talking actually directly about that and how much. And that's actually what I would actually go one step further is executives. I've seen that more with executives where that's actually a challenge. So you have this issue where options aren't worth what they are. And you're like an equity isn't in, and it's been so long since a lot of executives have actually had to do the work. So that since they've actually had to have these customer conversations, they've had these bigger teams, they've done a lot more of the dashboarding, and now they're actually having to dig in as
It's
well.
tough to go back to smaller teams too, right? It's tough to, it's just, I don't have the answer. I honestly, I just worry about it. I worry that the majority of VPs of sales I interview, VPs of marketing, customer success, even more junior folks, stretch folks, I worry just that, you can't break SaaS companies are so much more efficient now, right? Monday from cash flow negative to almost 20% margins in 5 quarters. Like the numbers are jaw dropping, and we're getting efficient by hiring no one for a year. That was the simple way, right? Grow 60%, hire no one, you get a lot more efficient, but it's not going to go back. And I don't think we've internalized all of this. And I think going to Samsung, I think people aren't working. I think everyone only worked 3 to 4 hours a day. It's just, we used to commute for 2 hours, including parking and getting there and pressing the elevator button. That was 2 hours. And then lunch was an hour. And then screwing around in the office was an hour. So it was like 8 hours of your day was work, but you only work 3 to 4. Now people work 3 to 4 or 2 to 3, but the rest of the time they're doing other things, right? And I don't think people are willing to give that back. Although it's funny, there were all the CROs I talked to, good ones backstage at SaaStr's, there were 2 themes that came out this year. One was everyone wanted to figure out how to get people back at least 3 days a week. That was the number one thing CROs wanted. Get whatever it took. Change hiring, reorg the team, whatever I could do to get folks in the office 3 days a week. Because no one cared about their top 5% performers, but the rest, they just felt the performance had deteriorated, right? The second theme was that they've given up on CS, a different topic. But the first one was, right or wrong, everyone wanted people back 3 days a week.
We were chatting about the CS thing in the last episode. So Snowflake's CRO had gotten rid of the entire CS team when he was given it. And he basically took the budget for CS and put it into sales and hired SEs and hired professional services people, and a business value team was created. And they basically gave the AEs a renewal and upselling target, and they've got great net revenue retention. It might be a quirk because of their pricing model and what they sell, but CS is something that's now finally up for debate in some cases.
Yeah, for sure. I think it is a function that is going to go through another phase transition now, right? Yeah. Just having 10% of your accounts show up to your QBR once a quarter and calling it a victory in an era of 140% NRR, I don't think it's fully behind us, but I think we're in a slow pace of that going into the rearview mirror. The phone it in CS, which was fair when things were easy, like it fair, but it may just not fit in an efficient era. If we're going to have to go to the 3 to 4 million per revenue per CSM, I just don't know how the current way most CSM works is going to work.
Yeah, I think it's going to require a complete reimagining, because there's so many. I've just talked to a lot of early VPs of sales or just early VPs, and their entire frame is benchmarking this many people to this size book of business without contemplating what's the level of automation, what's the level of engagement, like what can we actually get done. And I think most of what I'm hearing is that people are they just want CS to be fully automated, largely from the product itself, as opposed to having to have human beings serve as a buffer or intermediary between the product and the customer.
Yeah, I personally think part of that is terrible, but I do think that's the way we're going, right? Which is to the right or wrong, anything that can be automated on the CS side, people are going to try to automate it. I think it's going to lead to a worse customer experience, but it is an unstoppable trend. Any CS leader I just did a thing with Churn Zero, and they had a CS at HubSpot, and that was their whole theme, right? More automation. It's just all across the board, right? And I think in a perfect world, you wouldn't do it, right? Because we know the old SaaStr math that a truly great customer success professional is going to drive up the revenue per account. We've all lived it, right? But does a mediocre CS rep drive it? I don't think they help at all. In fact, most folks, the vendors that we use at SaaStr, for me, most of them are too scared to talk to me personally. Almost none of them will even talk to me.
Do they try to talk to you?
We had one. I'm not going to name vendors. It doesn't help. But there's this one vendor where we're one of their top 3 customers and have been for years. Okay, and the head of CS showed up, and we had this terrible experience, like about as bad as it could be with the vendor in terms of uptime, downtime. Like I'm not going to give you any specifics, but got to the presentation, the Cube. Like I don't go to Cuberas, but I went, and like everything's great. Here's all the terrific things we did for SaaStr's. I'm like, listen, I don't have time for this. Do you want my honest feedback? Because I built software. Like I'm here. Bear in mind, why am I here? Because I care. If I was going to churn or didn't care, I would not be here. Do you want me to tell you what's wrong with your product? And I've already given you like 5 of your biggest customers as word of mouth. I no longer recommend you. Do you want to know why? And she ended the Zoom.
Seriously?
Wow. What? Really?
And I don't blame her. Yeah, she just didn't want. It's just that, and then all of a sudden, it didn't want to know that. It was just, let's just get through my slides.
Wow,
Shit. That's 100% utilization, 100% that. No, it's not 100%. It's like
what was the name of that? I'm just kidding.
I've had so many. I can't do them. That's why everyone just.
I do. So you bring up an interesting point though. The CX going away, automation from HubSpot, automation from Churn Zero. The customer, they want to actually talk to someone. They want to actually get the feedback.
Everyone wants to talk to somebody.
Of course.
But they'll have AEs, they'll have SEs, they'll have PS people. Like they're people to talk to still, but those people might be better suited for that conversation is what the other side of the argument is. Like what the CRO at Snowflake is saying is, I would rather trust an AE to have the upselling conversation, to be opportunistic, to be able to handle good feedback, take it to the right people, and get the support of SEs and PS people to deliver immense value versus the CS person that's not a salesperson, but like, what is this role? That's his feedback on it. So you'd still have proximity to customer. We're not getting rid of that.
Yeah, look, I saw that, and obviously there's few companies more successful than Snowflake, but I think we should take it with a slight grain of salt. Yeah. I mean, how and where you do CS, you can't. I've run experiments of having sales do CS myself, and it's been a very interesting experiment. What I've learned, this is just my personal experience. It's not Snowflake. What I've learned is having sales do CS if they own the account. Okay. If it's pure transactional, it doesn't work, right? If there's no other commission to be had, it doesn't work. But if they're going to own the account and get more commissions, it works better than crappy CS for sure. Much better. Okay. Because they have some incentive to respond, right? There is no question that a good AE owning a renewal and upsell is better than a crappy CS account. But it ain't great. It ain't the level. You never have the level of fluency. You never have the incredible attention to just making them happy. They don't own issue resolution, but they do respond. Right. I don't think we've figured all this out. Right. And I suspect if we really deconstructed Snowflake, there's so many resources around that AE who's owning, and Mongo reps own the account for like 5 years too. I think there's so many resources around it that it's not that there isn't CS, it's just deconstructed, right? In a way that works for the customer, right? It's not like the reps really doing everything that classical CSM would do, right?
Yeah, it might not be an org, but like the philosophy of CS is still in those organizations.
I think so, right?
What about like you were saying at
SaaS? Now, Asad, a word from our sponsor. Are you a CEO or founder looking to get ahead in 2024? Then join me, Sam Jacobs, and over 100 high-growth CEOs and founders for Pavilion's 2024 CEO Summit. We're gathering at the elite Phoenician Resort in Scottsdale, Arizona, to share revolutionary insights and strategies on how to navigate the current economic climate with confidence and certainty. At Pavilion CEO Summit 2024, expect expert-led education sessions, hands-on workshops, and exclusive networking opportunities with fellow CEOs and founders from around the world, including the team from Topline, me, Asad, and AJ. Buy your ticket at joinpavilion.com/CEO Summit and use the code TOPLINE for 20% off. That's joinpavilion.com/CEO Summit and use the code TOPLINE for 20% off. I hope to see you there. That wasn't very smooth. You got to listen. All right, let's go. What were you saying?
So you were saying that CROs at SaaStr's were talking about two things. One was the CS, the other was this work from home versus work from office. They will all want these people back 3 days a week. You personally, do you think a technology company, let's say early stage, Series A, maybe Series B, can they build a truly ultra high performing team that's remote first? Is that a solvable problem?
I think it. Sure. First of all, look. Let's step back for a minute. That I think the real answer to all of this is that we actually have to build better software. SaaS software is much worse than software used to be. When in the old days of Adobe, Microsoft, Intuit, when you ship that piece of software on a DVD-ROM or whatever, you couldn't patch, you couldn't do whatever.
Yeah.
Like software used to be much better and now much less agile. When I briefly worked at Adobe, when we did quarterly releases, we had about 3 weeks to code, and the rest of the quarter was QA management. So like you only had 3 out of 12 weeks to write software.
And those are
now
only 2 hours a day.
Out of 12. Yeah.
Right. Those are only 2 to
day.
3 hours a day too. So.
Well, that's a piece of, but my point is now we have 11 and a half out of 12 weeks to build software. So there are positives to this, but I actually think all this software is much crappier than software used to be. And we get a lot of agility and functionality out of it, but we're using so many functions from customer success and more to patch these holes in the crappiness of our software, right? That's the number one complaint of good CS people is that they hate being firefighters.
Yeah.
Right. The mediocre ones just end the Zoom, like I described. The really good ones, their hearts are broken because they're spending 35 hours a week finding some vendor or some hack or some agency or consultant to fix the broken integration or to make this work and to get some Rube Goldberg-esque half hack to fix. And I don't know, the ultimate answer is if our software was much better, then bots and stuff could handle all this stuff. But I don't know how you solve that problem.
I mean,
right?
It is fascinating. You look at the video game industry, and video games inherently have been released early, like Cyberpunk 2077 last year, like just released way earlier than they should to. And it's just beta. And that's kind of what we're doing in SaaS in a lot of ways. I would argue it's gotten a lot harder to build software in the last several years with the expectations of customers around security, around upfront, around just the things that you need to do to stand up software, the build versus buy. If you've gone down the path of building, sure, you can pull OAuth, you can pull Okta off the shelf, but a lot of it, you have to be able, like, there's just a lot of points of failure along the QA that apps have gotten a lot more bloated as they've tried to be more competitive to keep up with feature creep. So it's just this constant, it's very agile, but the software and the coding itself has degraded quite considerably. I mean, the talent and the amount of engineers that's needed. So I think you're 100% right. And I think that's something that probably will change in the next 12 months in the end. Maybe not. I don't know. As a lot of companies struggle to raise funds and need soft landings, I think they'll be just focused back onto quality and just getting the right thing out the door on product roadmaps versus
it's complicated.
It's complicated. It's very complicated.
And part of it, AJ, is also that the software ecosystem has been growing at G2 had released that data that's 7% per quarter, from a supply of software perspective. So there's so many more companies, and are there so many people out there that are truly elite at each of their functions that all these companies can build great teams? So there's a challenge in terms of being able to actually have the caliber of teams to build and ship great products and sell effectively. That creates a challenge as well. Can we touch on OpenAI, guys? We need to talk about this.
Sam Altman was the CEO of OpenAI when we last filmed, and he's the CEO today, and
nothing's changed. Nothing has changed. Okay, so we have to talk about this. I think most of our listeners are aware of what's happening. Just for context, it's Wednesday, November 22nd. He's CEO again. But in looking at this situation, Jason, one of the big takeaways seems to be around boards. That Sam has
maybe.
Okay,
keep going.
So basically, this is what
everyone now is an interest rate expert. A macro expert and a board of direct experts. Kudos to the internet.
I'm
So
also
this is
a
what they're
Middle East
writing.
conflict expert. I'm a
D'Angelo
Russia-Ukraine
doesn't
expert.
understand
China,
boards.
I'm an expert in China.
We got presidential next year. We can do all the experts.
Reid Hoffman doesn't understand how boards work. Sam Altman's never seen a board before. But we all know better than Sam and Reid and Adam and all these folks, right?
Okay, so there might be a takeaway there.
We're all bored. If only Vinod had listened to me and Sam, my views of the board, none of this would have happened.
I didn't say
Sam,
anything.
where were you? Why weren't you listening to me, Sam?
By the way, Sam, my wife said the hardest she laughed ever at an episode is when you made the comment around if people are fundraising for Series B or above, they're probably not talking to me. she appreciated that comment you made last week.
Well, as M&A activity. All right, Asad, ask your question.
Okay.
I do think boards matter. I just think it's more nuanced than
It's
than the armchair
nuanced, but I think
quarterbacks
what
say,
Sam
right?
has, what people have said that he shared is that he's a little bit frustrated that he didn't structure it the right way, in the sense of the 4 board members left or 3 board members left. He should have brought new people in. He had a bit of a riff with these people. He should have better managed it. That's what he shared with some people that's been written about. So
Yes.
board became an equation here. When you think about when the market was hot, you had crossover funds like Tiger that were giving money to founders with asking for very little in return and not asking for board seats. At the time, founders thought that was a feature. I think that's a bug when the market turns and you need your investor. They don't even want to attend a board meeting or come or talk to you, right? Like it's too small a stake at too early of a stage. And so on the other side of it, as the market has turned and you asked founders, what's causing you stress? Board relationships is one of them. They're like, hey, these investors, they're spending less time in market. And so they have more time for us and it's causing a lot of stress. And so just your general reflections on the OpenAI situation. Have you taken anything away from it that's interesting? And secondly, what advice do you have for especially early stage founders when it comes to board building? Because founders might be just saying that, listen, I'm an early stage founder. Investors aren't bending over backwards to give me money right now. I don't get to design my board. It just materializes. Is that just the way it is?
Well, let me step back a minute. The OpenAI thing, it's crazy because it seems crazy to us because you have a nonprofit managing a for-profit.
Mm-hmm.
And the nonprofit board maybe was fairly representative. It had 3 founders on it, right? Sam, Greg, and Ilya, at least 3 founders. It had outside directors who quit. It had Reid Hoffman, Elon Musk's person that they both left for whatever reason. So there were 2 good outsiders on it, and
there was that presidential candidate as well.
Yeah, and then there are a couple, whatever, anti-progress or whatever people, whatever. It was a pretty balanced board with a weird funk. Like what really happened here is what we talked about earlier, which was, as crazy as this is, people need to make bets and outliers. And so you have guys like Vinod Khosla, one of the greatest investors of all time, first investor in OpenAI.
For sure.
And he's investing in a for-profit sub and has no record, but he also knows what an outlier is. And so they'll take these risks. Even FTX, I think the biggest issue with FTX wasn't this, it's just that there was fraud. But the numbers,
but governance might have thought that fraud
is fraud. I don't know that governance is, listen, I've been investing for a little over 10 years. I haven't had too many issues, but I have had 2 founders lie about the numbers.
How egregiously
Now,
did they lie?
After you invested.
Yeah, lie. And
like 10%.
I do a certain amount of diligence. I have an accounting guy review the bank statements, some other things, but there are still ways that and I'm not saying fraud like we had 100 million revenue at 0, but I'm talking about misstating things that aren't really ARR, compressing revenue that is really annualized, things you shouldn't do. And I don't know that that governance magically solves everything. I think the issue, there's a lot of issues you touched on in terms of this having a board that's supportive. If you have no one on your board and then times get tougher, you have no one with skin in the game, they're not going to give you any more money. But I don't think founders should be surprised. Right? I think you should ask, listen, at the end of the day, no one does this. It is entirely appropriate for a founder at the end of every board meeting to ask 2 questions. How am I doing 1 to 5 or 1 to 10, whatever you prefer? People have different flaws. How am I doing? And what, yes or no, would you give me more money if I need it? Ask every meeting, every month. I would tell anybody if I give you more money, yes or no.
Interesting.
Ask.
Yeah.
Why does nobody ask?
We're scared of the
That's
answer.
interesting.
And if you don't have board meetings or a board, there's no one to ask. So no one's going to give you more money unless times are really good. And maybe that's okay. Like, I don't know how the kids these days don't realize that they have to make the allowance stretch the whole week. Someone gives you $1 million, 10 million, 100 million. Maybe that's all you're going to get until you get more. Like, who told these kids that more is always coming?
Yeah, that's
I mean,
interesting.
my board
Woe is you.
explicitly told me 9 or 10 months ago, there's no more money coming. You better fucking figure this out.
Good, you didn't have to ask. It's good to know, right?
I know, it was good to know.
Sam didn't need to follow up with the 1 to 5 question. He got it up front.
It was a 1.
It's just okay. It's okay to ask. It's okay to ask.
Do you think
you don't
can
always know and different people, and actually, if you want to get nuanced in it, depending on your company, different people may have very different perspectives depending on when they invested, how successful they are, right? The more successful an investor is, the less they sweat the small stuff. It's just reality. It's not good or bad, right? And also, some folks, and also if you have an investor that's either investing their own money or runs the fund, they have more latitude sometimes than other folks, right?
Yeah.
So my point is, you just don't know unless you ask.
Brian Halligan had a really good article around this and had like 15 points around board setup, just from his perspective.
He did, although it was interesting that Parker Conrad said it was all wrong.
Yeah.
Oh, he did.
I
I
love
didn't see
Brian.
that.
I deeply love Brian.
I didn't think Brian
Parker,
was look, his wasn't super prescriptive to what OpenAI. The one thing he did say is that at the end of a year, do a 360 with your board as well, which I thought was an interesting take. Jason, have you done any 360s with your boards? Like every board member gets graded as well?
Well, look, I do think that no, a little bit. The world has, since HubSpot was found, and we may be more like HubSpot in the coming years, right?
Yeah.
But for the last years, the world has changed. I have a different experience. One of the best investments I've made that I think will triple this year and triple next year. The largest investor still refuses to take a board seat because they're too busy in a big fund.
Wow.
They just invested another 15 million the other day. They're totally supportive, completely supportive, but just don't want to do I've got another one. Probably there's another investment, one of my best current investments. I'm the only director outside of the founders and probably will be until IPO because they don't need any more money. So the world, I'm not saying this is bad. I mean, Brian clearly benefited, and his point is I was a first-time CEO. I had Sequoia, he got so much benefit from it. And I think that sounds great, but just the world in some ways has changed, right?
Well, yeah.
And it may revert back to the way it was through that, but also just companies are built and constructed differently. The 200 companies that go through YC each batch probably will never have a director from that round, right? It's just the way it works. And we could criticize it, but it don't really matter what the four of us think, does it?
No.
Thinking about we know what the world, you've spoken about later in 2024, IPO window opens up. We don't know what happens with valuations, which I think is a really good point, but you've said that at least the window might open up, right? Or you put some money down there.
It's open. It's just no one wants to walk through it, but it is open at the moment. After
it's
Instacart,
a door that no one wants to take.
and an arm. Yes.
So what are your thoughts on the path from today till that second half when the window opens up? What's going to happen? How do you see this playing out, especially on the growth side? Like, what percent of companies right now at that growth stage do you think survive till then versus might not even make it past this point?
Survive until then. I think anyone that's going to IPO next year, it's not about surviving.
Yeah,
I've got probably 4 companies I've invested in that are at or north 200 million, growing at pretty good rates, and are cash flow break even or efficient. So they'll all be able to IPO when they want. And the question is the valuation, right? Mm-hmm. Does it make sense? I think if you're a unicorn running out of money and not growing, you don't really need to worry about the IPO window, right? SaaS is so big, however we measure it, there are so many companies north of 200 million with decent metrics, just quietly backed up waiting to IPO, right? And even if some of them have seen a growth hit today, I don't know what an outreach or someone is at. I don't think in a year and a half the growth won't be bad, right? Whoever the impact, they're not going to be impacted forever. They're all at 200 million or north, right? The Gongs, and forget about the Databricks. So there's a long line waiting. In terms of the fallen unicorns, I mean,
Outreach is trading at like 4x right now.
What's that?
Outreach is trading at about 4x of revenue then in the private secondary markets, which is wild. Yeah.
Well, they're contracting too.
What's that?
Yeah,
they're contracting, or at least they contracted from Q2 to Q3.
Yeah.
I think, look, first of all, the secondary markets, I mean, this is a pretty niche topic. My limited observation is that unless you're super hot, everything in the secondary market is basically trading at half the last round. Okay, this is there's just not, you can try to do these complicated analyses, but at the end of the day, the limited amount of buyers in the sector, they're all making, I get the same ask, everyone, hey, are you willing to sell shares in A, B, C, D? And it's always the same. It's 50% of the last round. Okay.
Wow.
You could say that there's a careful DCF analysis in there, but I think it's just a thoughtful approach to bargain hunting to keep something simple, right? So whatever that outreach or whatever, I don't take those discounts too seriously. I think you can take fresh new rounds a little more seriously, but the secondary is just, it's a thin market, right? It's a thin quirky market. What I do think the one thing, it's a pretty interesting, I'll tell you what is for founders or others, here's what has changed and I think should be sobering. So I've got a couple companies now that are actually in both cases are pretty capped. They don't need any money, but they are looking at doing growth rounds at the moment. And it's very interesting what the market feedback is.
Tell us.
And you should think about it. The market feedback in 2021, yes, it was high, but you know how growth rounds worked is it a winner? Then I will do then what price clears. And that sounded stupid, but it wasn't stupid the way the market was going. Okay. If the price was 700, but it was clearly breaking out, then that's what market was. You didn't really worry about it because you knew it had a shot at being 1.4 and 2.1. That's the way the market worked today. Today, those same growth investors, I hear this, I want a guarantee of an 8 to 10x, a guarantee. No one said guarantee in 2021. And the truth is, people believe they would get those multiples, but no one said it out in the conversations because the multiples. Now, if you want to raise at 500, that means, hey, I need a clear path to 6 to 7 billion with dilution. Not hope or dream or reflation. And so just realize how much pressure that puts on any growth round when people will do the round, but they want a guarantee of 8 to 10x.
Well, we're seeing that in the term sheets as well, right? Whether it's the participation or IRR is actually in the term sheets of
sometimes
they're going to get they're going to get that guarantee.
I don't think these participation structured things are like as big a deal as the internet makes it out to be, but you see hints of it there in terms, right?
We had and for TrendKite, we had an participation for our Series D, and we cleared it by like just the skin of our teeth right before exit.
Or you don't, and so what? So the price is adjusted a little bit. Who cares?
It's a little bit down, and the common gets a little bit, but no one's the wiser, truthfully, on that except for the CEO.
If you're just overpriced a little bit, people get too. It's like OpenAI. People get too passionate about some of these things. I just think people just have not internalized. Even today, even with everything you see on LinkedIn and everything, people have not internalized how much harder the next round is. If I only had to tell people one thing, no matter what you think, it's harder.
Yeah.
No matter how hard, I just can't, especially first-time founders, they just can't internalize it. They can't internalize it until they get a mountain of feedback. I don't, I can't, that's the biggest takeaway. I don't know why they don't internalize it. But most folks haven't raised money in more than a year, and it's hard. It's just however you think it is, it's harder.
That's why none of us are going to raise ever again. That's it.
Maybe I don't think it should be so things coming back, but it's just there's optimism is good, except in your odds of fundraising. It's the only place where optimism bites you when you're too optimistic about it, right? Yeah.
Jason, thanks for joining us. It's been awesome having you. You're going to be in Scottsdale January 24th and 25th for our CEO Summit, if I'm not mistaken.
Scottsdale. Yes.
Yeah.
The home
Awesome.
where all leadership ends up one way or the other.
Yeah,
Just really looking
Whether it's
forward
in
to golf then.
retirement
We all
or
just
for
wanna
the
golf.
Pavilion Summit, we'll all end up on the backlinks in Scottsdale. Scottsdale's great. It's great.
You can stick around for our segment if you want. We're doing shout outs, wins of the week, and it's Thanksgiving week. So we'll all go around and figure out what we're shouting out, what we're grateful for. AJ, why don't we start with you?
Oh, why the hell are you starting with me? Like I'm sitting here like writing things down, trying to think of something.
Fair enough. Asid, are you ready?
Yeah, sure. I'm actually quite thankful. So I've spoken about this before in one of the episodes. My mom's been battling cancer, and she got it once in 2021, beat it, got it again. And we just got the results literally 2 days ago, and she has beaten cancer for the second time. This is a 100-pound, 75-year-old lady. I think she's 75. She hasn't told us her age past 40. But she's beaten it for the second time, and we're just really thankful for that and proud of her. So shout out to her.
Awesome.
One of our 3 listeners.
All right. There you go. I will. I'll continue the trend. I'm down here in Northern Virginia where my family is. It's I've got a brother, a sister. I've got 4 different nephews and nieces, and my parents are still around, thank God. And it's always wonderful. We've been coming back here for Thanksgiving for a very long time, and I'm just grateful to have my parents, especially in good health, and to be able to eat some turkey with them. Go to a Capitals hockey game tonight. Hopefully, see them beat the Sabres. And that's my shout out. It goes to the family Jacobs, including Ambassador Susan Jacobs, who served as the U.S. ambassador to Vanuatu, Papua New Guinea, and the Solomon Islands.
Look at that.
Jason,
I'll go ahead and
go ahead, AJ.
I wrote it down. No, I'm going to shout out my co-founders, Eric Heidenberg and Cole Evitz. We had a hackathon this week, and we just had an 1.5-hour demo, and both of them have, after 5.5 years, are just driving, and such awesome, inspiring things that came out of it that are going to be production ready. Interestingly, talking to like software challenging, but no, it was really good to have them dig in, and they're still online working through some customer requests of folks that need to run payroll, and that's really important. And both of them are just high flyers. So really thankful for co-founders and all the co-founders out there that are digging in over the holidays to finish out the year strong.
Awesome. Jason, you're last but not least.
Wow, I should have something more specific. I'm just thankful, tying to our conversation. I'm just thankful to everyone that goes the extra yard. I'm thankful to everyone that's a true pirate and romantic, and that for me personally has been part of any of these journeys. It sometimes feels like there's a fewer of us, but I'm going to make sure that I send a note between now and the end of the year and a few nickels to everyone. And because I think, just cherish those today that go the extra yard, cherish those that do more than they need to, cherish those that have even a hint of the passion that you do, where it's somehow rubbed off on them. And that you're not just one of their 8 side hustles. They're rare. And I'm going to make sure I'm at many levels. I'm grateful to all of them.
Beautiful.
And this has been another great episode of Top Line, folks. Thanks so much. Jason, thanks so much for joining us. It's been amazing to have you. We'll see you in Scottsdale in about a month and a half. And everybody else, we'll talk to you on Thursday for Top Line Hotline.
Bye, everyone.
Bye, everyone.
See you later.
Thank you for listening to this episode of Top Line. To learn more about the trends, news, and developments impacting the world of B2B SaaS, head to joinpavilion.com, where more than 10,000 of the world's top go-to market leaders go to achieve and unlock their full professional potential.